Thanks for tuning in to Retiring Well. Have a great show lined up for you. Talking first about gifting and giving money. What does that mean, and what can you take advantage of when it comes to the taxes out there? Along with that, you may have heard in the news sort of these Trump tax cuts. What does that actually mean, and how does it apply to you? Along with beginning to prepare for retirement now. Don't delay. You want to be taking steps now, no matter what age you are, to be preparing yourself. And then lastly, 2025 tax tips. There's so much going on in the tax world. You want to be paying close attention to all of this and a whole lot more coming up right here, right now on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Welcome to Coffee Talk. John Torbett, Art Canfield here, senior partners of Centennial Wealth Advisory, and Art and I go back 35 plus years, all the way back to kindergarten here in Traverse City, and we've been friends ever since, even though sometimes I like to get under his skin and tease him a little bit, but he's still hanging around me, so that's a good thing. One of the areas that we come across quite often that people aren't necessarily spending a lot of time thinking about or talking about is the concept of how to gift money or even how to give money that ultimately can be beneficial to keep as much money in your pockets or the charity that you want to support versus Uncle Sam. I think everyone can agree, hey, we'd rather see the individuals, the families, or the charities benefit as opposed to the government getting more and more money.
Right, often so, right? And I think that's important here when we're talking about gifting and giving. You know, we love having those conversations where we're talking with family members or, you know, as they're aging, helping their children, helping their grandchildren, stuff like that. You know, at this point, the IRS isn't giving you any big tax deductions for gifting or those assets to your children, you know, at this point. So let's keep looking for that. But the conversation today is going to be more around kind of those nonprofits, churches, charities, stuff like that. So one of the things, you know, when we think about this that is seldom used, but one of the neatest things out there, I think, when you get to that required minimum distribution age, is qualified charitable distributions, QCDs. It's a way that you can use those required minimum distribution dollars, give them to your favorite church, charity, organization, and be able to not pay income tax on that. It's a beautiful thing, and if you're not taking advantage of that, and you're of that required minimum distribution age, you're likely missing out.
Yeah, most definitely. So really after age 70 and a half, at least as of the current rules and everything, allow you to start giving to the church, charity, etc. So we've got a number of clients that are regularly tithing to their church. So they had been doing that out of their bank accounts and everything. But once they reach age 70 and a half, now you can take these taxable IRA dollars and instead use that to give the money to your church on a regular basis. And you're not paying tax on those dollars, and neither is the church. Along with that, you can set that up if you want to donate to a charity. We've got a client who, a lot of times people joke about, well, are my kids or grandkids a charity? No, but if they are in charge of, say, a 501c3, a qualified charity, then yeah, we have a client that does that on a regular basis and helps support her son by giving to that charitable organization and everything from the IRA. So again, it's a non-taxable event. Those dollars count towards the required minimum distribution. So if you had a required minimum distribution of $20,000 and say you gave $5,000 to the church or charity, that goes towards that $20,000. So now you may only pay tax on the remaining $15,000 that you distribute to yourself. So again, saves you some tax dollars.
Absolutely. Again, wonderful tool to do it. If you're not using it, look into it. You know, talk to your financial advisor about that. Talk to your tax person. You know, they ought to be able to help you with those. Gosh, I think, you know, when I think of, you know, a lot of times end of the year is a popular time, but it can happen any time during that tax year when you're giving those dollars out there. When we think of other types of giving, you know, there's obviously cash gifts and stuff like that, but many people have assets, whether that's stock, you know, might be appreciated stock that they've held for years and years or even passed on through generations. You know, there's some unique ways and also some advantageous ways to gift stuff like that too, right, John?
Yeah, most definitely. So we had a client that had inherited some stock. So this is after-tax money, and it had appreciated. They didn't necessarily settle the estate right away, and they had a favorable year in the market. So these stocks had appreciated, and so now if they were to go and sell all those, they would pay capital gains tax on that. But we were talking through it, and they sort of found, well, this is money we don't necessarily need for our retirement, but we could really help our kids and everything. And so there was a way to start gifting some of these stocks to the kids who are in a lower tax bracket, who then could make the choice whether they wanted to sell those stocks, pay the capital gains, and ultimately use those funds for their purposes. So it was a way to give money to the kids in a way where it didn't hurt them from a tax standpoint, and ultimately help their kids flourish.
Absolutely. If this is something you're interested in, looking at those QCDs, looking at gifting some stuff to your favorite church or charity out there, we'd love to help you through that and set up a plan so that you can plan to retire well. Taxes follow you even into retirement. When you start taking income from your qualified retirement accounts, taxes are owed at your ordinary tax rates. Our holistic retirement planning approach includes tax planning and implementing tax reduction strategies. Centennial Wealth Advisory can help. Call the number on your screen or visit our website and request your complimentary initial consultation.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college. How will I remember you?
Have the retirement you dream about. Contact us today.
Lately, we've been having a lot of client conversation with clients in the Traverse City office or individuals coming in from the TV show about, since the presidential election, sort of the impact of potential tax cuts by Trump. One of the things we want to take a step back on is not necessarily just looking at the tax cuts. What does that mean from an overall economy standpoint? Then what does that mean to our investment portfolio? So one of the things we do have to think about is with this potential tax cut idea, what is that going to do to our deficit? Right now we're sitting at $36 trillion in debt as a country. If we drop that revenue source from taxes, we're potentially going to see that deficit climb up. There's going to be a potential impact to that, to inflation, then ultimately to our bond portfolio. So we want to be thinking about this impact, not necessarily just on what it can do from a stimulus standpoint, but also sort of the bleeding impact down the road. When we look at the overall deficit right now, the reason the tax cuts are being proposed is this idea of tariffs to kind of offset that revenue. Tariffs aren't new. If we will go back 10 years, never really was on the news. Right now, if you turn on CNN, Bloomberg, whatever news channel you want, probably the hour you're watching, tariffs are going to come up in the conversation at some point. So the idea is, well, if we cut taxes, we'll just increase tariffs and that'll offset the difference. It doesn't necessarily work like that. We also have to think about if we do see tariffs go up as high as they're proposing them, because we could see a pretty dramatic impact, that can also have an impact to current inflation rates. We saw back in 2018, the last time we had the quote unquote trade war with Trump and China, we didn't really see an impact to CPI at that point, but that doesn't mean it's going to happen now. I'm hesitant to rely on that data because I was pre-COVID, which was, in a way, almost a different world from an economic standpoint. So we do want to be thinking about if we see tax cuts go through, the impact that can have to the deficit, and then ultimately what's going to happen to the different bond portfolios that we have. So what's important to look at is how the bond market is reacting from the election, and we're seeing essentially this battle right now between fiscal policy and monetary policy, and time will tell which of these are going to win. But when I say there's a battle here, is the fiscal policy is what the government is putting in place or projecting to put in place around tax cuts or immigration policy or tariffs. These types of things are almost stimulus type programs, specifically tax cuts, that gives more money to us as a consumer, more money to spend. The bond market is pricing that in. If we look back in history when we've seen any sort of rate cutting environment by the Fed, the 10-year Treasury yield tends to go down. Bonds and interest rates have an inverse correlation. So when interest rates are going down, bond prices should go up. What we've seen happen is on the front end of the yield curve, the Fed is cutting rates. That's impact your CDs, your money markets. But the 10-year Treasury yield has actually gone up. That's caused a lot of volatility in your bond portfolios. The last time we saw anything like this was in the early 80s, which was also a high inflationary environment time. It was also a recessionary environment time. Not calling for a recession, but something we should be thinking about. How does our bond portfolio react to these different things that we're seeing in the economy? And why we're seeing this battle is the Fed is projecting to have interest rates go down. They're trying to get down to this 3% target is where they want to ultimately land. But as we saw, the market isn't agreeing with that. And usually the market tends to be right. So we're seeing the market basically ignore what the Fed's doing and focus more on that fiscal policy piece of the equation. That doesn't necessarily mean we go and abandon our bond portfolios. When we look back over history, 44 of the last 49 years, the U.S. aggregate bond index has been positive, albeit not a lot. And once you adjust for inflation, it would be negative. But there's a consensus that long-term bonds offer some opportunity, certainly to offset risks that we might be taking in other areas. It might be time to start to look at municipal bonds. This is an area that's underperformed, but the pre-tax equivalent yield is at a place where it's pretty attractive right now to have that municipal component in that bond piece. So maybe diversifying the types of bonds that we have, and maybe have more corporate, more municipal, not so much just governmental, because that's what's being impacted the most by this conversation of fiscal versus monetary policy. Ultimately, it comes back to being diversified, right? We never know which of these asset classes are going to perform the best into the future. We want to have diversification between all these different pieces. So we don't know necessarily which of these sectors in the bond market is going to be best. So maybe having some diversification in there, also being diversified by tax strategy, by investment strategy is going to be the best way to set ourselves up for success long term. So if you don't know where to start, please reach out to us here in the Traverse City office. We'd be happy to sit down with you, build out that overall financial plan, align your investments with when we're going to need the money, and ultimately take that risk questionnaire so we're not over allocated in certain areas. But ultimately, we're probably going to be up for a bumpy ride here in 2025. It's a good time to start looking at this now before we get behind the 8 ball.
In our ongoing effort to provide quality financial education, we are now offering a free downloadable white paper titled Tax Strategies for Retirement. Learn about tax reduction strategies that can help you reduce your liability and increase your cash flow. Simply go to cen-wealth.com, scroll down and click the link Tax Strategies for Retirement to receive your free copy of our valuable and informative white paper, Tax Strategies for Retirement.
You can have a portfolio or you can have a plan. You can play it safely or you can safely plan. You can guess when to take Social Security, or you can make your decision based on detailed analysis. You can hope your savings will last your entire retirement, or you can take action and know. You can let life happen to you, or you can take control. You can go it alone, or you can have an experienced guide ready to walk with you every step of the way. We are Centennial Wealth Advisory, financial planners serving all of northern Michigan, offices in Gaylord, Petoskey, Traverse City, and Cadillac. Simply call the number on your screen for a complimentary initial consultation and let us help you plan to retire well.
When it comes to your financial future, what's the value of a truly objective opinion? As someone looking for financial guidance, you have choices. There are thousands of captive financial professionals who work as employees for large national insurance companies and brokerages. There are also many independent financial professionals who aren't bound to any given insurance company, investment strategy, or product. So what's the difference, and why does it really matter to you? Consider this. If you walked into a doctor's office with a sore throat, a bad cough, and a high fever, you'd expect that doctor to assess your symptoms, do a thorough diagnosis, diagnosis and ultimately hand you a prescription written to cure your particular ailment. In other words, you'd expect the doctor to consider all the medications available and give you his or her absolute best thinking on what's best for you. On the other hand, if that doctor opened the cupboard and only had 3 or 4 prescriptions available, maybe those offered by his or her favorite pharmaceutical rep, most patients would immediately raise an eyebrow, suspicious that they might not be getting what was really in their best interest. The same may be true for your financial well-being. If your financial professional is an employee who's contractually bound to represent a given insurance or investment company, only offering their products while there are literally hundreds of others available, how sure can you be that you're being offered what's truly best for your situation? You don't walk into a tailor or seamstress shop to get clothing off some rack. You go for a custom-tailored fit. And with something as important as your financial future at hand, the stakes are even higher. We believe you deserve a truly objective opinion. We think you deserve to consider more of the available options. And we believe your financial future is worth a custom-tailored prescription to help you feel confident for the days ahead. If you'd like a second opinion on your current retirement strategy, simply contact our office today.
Envision yourself in retirement. What exactly does that look like? Do you want to travel the world with your spouse? Or maybe sell your home in Michigan and move to the Bahamas? Or maybe move closer to your grandbabies to watch them grow? Lifestyle is a great topic to start with when determining what your income needs are going to be when planning for retirement. I know that my fiance and I have a bucket list of travel desires. It will likely trickle into our retirement years. Putting together a comprehensive plan will be beneficial in getting a big picture idea on what this looks like and how much you might need to save up for these desired expenses. Not to mention the cost of living adjustments that might entail as well. Another question to ask is, have I paid my debt off yet? And if I am currently paying off my debt, what's the amortization date? If it's after the desired retirement age, that is something that we'd want to dive into. Ideally, you'd want to go into retirement debt-free or at least close to it. Taking a look at what your debt actually entails and paying off maybe the highest interest rate first can maximize your savings. My favorite quote from Tony Robbins is, "Action is the most important key to success." So if you're worried about your debt and haven't quite figured out how you're going to pay it off before retirement, action is the most important key to success in this. Now, are your current investments moving the needle towards your goals? It may be worth assessing whether or not you might need to tweak some things here and there, and if you need to make adjustments in certain areas. Recently, I was meeting with a long-term client, and she has a daughter that is around in her 30s or so. And so she has a couple of IRAs that are from different employers here and there, and they're just all over the place. So we had her come in, and we consolidated those for her and developed a comprehensive plan for her to help meet those retirement needs in the future. She also was currently working for an employer. She had a 401k, and we kind of directed her towards the website maybe to be able to update that to also meet her needs. When you look at your IRA or 401k, is it really all your money? Just think about that for a second. When you start doing distributions, Uncle Sam and the state of Michigan gets paid too. A great strategy to consider is when you go into retirement, you're likely at the lowest tax bracket. This is a good time to explore those Roth conversion options. Another question to ask is, are you looking to leave behind a legacy? I know that I've met with a lot of clients in the past where one client will say, like, we don't want to leave anything behind because our relatives don't necessarily need it. And then we also have clients on the other hand that don't want to spend anything at all, which can be really stressful. So it's very important to keep in mind what you want your end goal to look like. Another question is insurance. This is a big buzzword when it comes to retirement. Will you retire before the age of 65, before Medicare coverage kicks in? And how are you going to bridge that healthcare gap? That's a big question to ask. Another hot topic is long-term care coverage. Is this something that may be suitable for you? Maybe a good idea to look into life insurance option with a long-term care early withdrawal option. Because if you don't need that long-term care, then the death benefit will be there tax-free. A licensed agent can assist you here at Centennial Wealth Advisory for your insurance and long-term care needs. If you're someone who is already retired, maybe it's time for that retirement checkup to make sure that all of the facets in your schedule are in place to successfully plan to retire well.
In our ongoing effort to provide quality financial education, we are now offering a free downloadable white paper titled Tax Strategies for Retirement. Learn about tax reduction strategies that can help you reduce your liability and increase your cash flow. Simply go to cen-wealth.com, scroll down and click the link Tax Strategies for Retirement to receive your free copy of our valuable and informative white paper, Tax Strategies for Retirement.
In today's day and age, with a longer lifespan, you're more likely to encounter both good and bad market performance. For that reason, when planning for retirement, it's increasingly important to seek guidance from a financial advisor who can help you structure an income strategy that reflects your financial situation, risk tolerance, and investment objectives. You don't want just any advice, but objective financial advice. With so much at stake, it's important that you feel you can trust a financial advisor to consider a wide variety of possible solutions, including both investment and insurance products. Here at Centennial Wealth Advisory, we're not beholden to any certain investment tools or vehicles. We're independent. We can offer a wide variety of investment tools that meet your needs. So please, if you have any questions or you want to schedule an initial consultation, don't hesitate to give us a call at the number on the screen. We're happy to help in any way that we can.
At Centennial Wealth Advisory, we take a holistic approach to your retirement planning. So it's not just looking at what your investments are, but what is that long-term income plan for the next 30, 40 years of your retirement? What about taxes and what role they play in your retirement plan? Estate planning, what about life insurance, health insurance planning, all key areas to consider when looking at your retirement. So please visit our website or call the number on the screen. We'd love the opportunity to sit down with you for a no-cost, no-obligation visit.
All right, folks, as we enter another year here in 2025, we're kindly reminded of one of the certainties in life that Ben Franklin mentioned many, many years ago. It is time, as you probably know, to start the process of filing our government forms and submitting those to the IRS, State of Michigan, and other taxing authorities here. So I want to just go over 5 quick tips regarding preparation and completion of your taxes. You know, the first tip, probably the most obvious one, is to make sure that you file your taxes on time. The tax day, as we have become aware of, is April 15th, probably a day that is in most of our minds there. That is the tax due date for your 2024 tax returns, April 15th of 2025. And just as a friendly reminder, if you do need more time to file your income taxes, you can file an extension, and the IRS will give you 6 additional months to actually submit your tax returns there. The process to do that is to file a form called 4868 with the IRS, and this can also be electronically filed as well as paper filed. So make sure that you do that. If you do need that extra time, quick reminder that an extension of time is not necessarily an extension of to file, rather, is not an extension of time to pay your income taxes. So just keep that in mind. Number 2, knowing the difference between a tax deduction and a tax credit is really important. Tax deductions are subtractions against your income that you can use to reduce your taxable income and therefore, the tax liability that you ultimately owe. Whereas credits are reductions of the actual tax liability of itself. Things like tax deductions would include items such as, but not limited to, like medical deductions, State, local property tax deductions, your mortgage interest is a really good example of that as well, and then of course charitable contributions. So those are items that you can use to deduct against your income when computing your tax liability. However, in reality, as we speak here in tax year 2024 and 2025 going forward, most taxpayers actually take the IRS allowed standard deduction. This is the case per Tax Policy Center that 90% of U.S. taxpayers actually take the standard deduction in lieu of itemizing deductions or taking those deductions for those other categories that I just mentioned. So just keep that in mind as you're gathering up your information to determine your deductions. Many taxpayers will take that higher standard deduction. If you're curious about what those are for year 2024, the standard deduction for a single taxpayer is $14,600. And for a married couple filing jointly, it's $29,200. Additionally, you do get an additional deduction if you're over age 65 and or blind or deaf. So just keep that in mind. Some of that information when you're gathering to prepare your taxes may not actually be utilized, as the standard deduction could give you a greater deduction. When it comes to tax credits, there really are two categories of those for federal tax purposes. There's a refundable and a non-refundable credit. A refundable credit would be something that does not require you to actually have a tax liability in order to take the credit. This could be something like the Earned Income Credit or a portion of the American Opportunity Credit, which is an education-related credit. Non-refundable credits are items that require you to actually report a tax liability on your tax return in order to claim the credit. So an example of this would be something like the residential energy credits that you can get for certain improvements you make to your house that are energy efficient, such as, but not limited to, putting in Energy Star appliances, windows, electric vehicles, things like solar, wind, geothermal energy source, that energy generation products there can also apply for that. So just keep that in mind there. Number three, just also keep in mind that the deadline for making a prior year contributions to certain accounts is also April 15th. So the IRS allows you with certain types of accounts to make a prior year contribution that's actually retroactively applied to the previous tax year. The most common examples of this would be IRAs and Roth IRAs. And health savings accounts, HSAs, if you're covered by a high deductible health plan, also allow you to make those types of contributions as well. Number four is just to keep in mind that when you are filing your taxes, you're not just filing a federal form typically. You may also be filing a state or local income tax return as well. And something like that here in Michigan is something that taxpayers will file in the state, because Michigan is a state that does have an income tax. So just keep that in mind when you're filing to be in the know about changes with different state and local income tax laws. Number five is to, if possible, to e-file your taxes with the IRS. This is a really important thing to do in terms of making sure that your refund is processed more promptly. And making sure that you're using a reputable service for that. Tax preparation is really important, as well as tax planning, which is more of a future-looking item. There's a tax paper online through our website that you can download by going to www.cen-wealth.com.